I'm Jordan Hucht of Vision Wealth Partners, and today we're going to talk about a guide to weathering market volatility. Regardless of how long you've been investing, bouts of volatility can be unsettling. They can oftentimes be unexpected, and they can leave you feeling uncomfortable or concerned about your financial future. So let's talk about what you should think about, what you should focus on, and what you should do during times of heightened volatility. First, remember that all investments carry some amount of risk. Generally, when we think about the risk of an investment or a portfolio, we think about how volatile it is. How much does it fluctuate in value day over day, month over month, year over year? In most cases, there's a trade-off for higher levels of volatility in exchange for potentially higher rates of return over the long term. Now, that's a fundamental tenet of investing, and it's simple enough to understand, but it doesn't necessarily make enduring bouts of volatility any easier. Next, I think it's important to keep historical context in mind. For example, over the past 40 years, the S&P 500 has had a greater than 10% decline more than half the time. In fact, the average intra-year drawdown of the S&P 500 is about 14%, yet we've finished the year higher in more than 75% of those cases. Now, that's not to say that market declines are never concerning. Certainly they can be, but it's a reminder that volatility is a normal and necessary part of investing, especially to the extent you're investing in equities. So what should you do? The most important thing, stay disciplined and keep a long-term perspective. Sometimes it's easy to get caught up in the moment, but these are times where you need to prioritize long-term outcomes over short-term emotions. When markets are volatile, focus on the time horizon and cash flow needs of your portfolio. This is where asset allocation is critical, and thoughtful long-term planning should be dictating asset allocation. A properly allocated portfolio will have the right balance between stable assets for short-term needs and riskier assets for long-term growth. Remember, the goal isn't to eliminate volatility from a portfolio. The goal is to avoid having to sell a depressed asset. A good financial plan should be stress tested for volatility, and not just the variability of investment returns, but also the variability of inflation and other important variables. By randomizing the sequence of future returns, we can use predictive modeling to project the ability of a portfolio to meet its future cash flow needs, and then use that data to determine appropriate portfolio construction. You can't predict bad markets, but you can plan for how to handle them. With proper planning, you can find comfort in an otherwise uncomfortable time. And always favor discipline over emotion.